All right. Good evening, everybody. Good to see you guys again. And a couple people loading on as we speak. So just kind of take a second and let everyone log on that's going to log on. All right, guys. So good evening. This is the Hurley Investments Trade Findings and Adjustments of February 2nd. The last time I was here with you was mid-December, which kind of seems like forever ago, but really is not. So let me just edit that. February 2nd, just to kind of glance at what we were talking about back on the 15th. Talked about Disney and how it should be priced similar to Netflix as a media company. Let's see where Disney's at. I mean, where was December 15th? So around here. And it didn't get too far away. I mean, 180, kind of lower now, 176, but higher than it was. Kind of interesting. Disney should be a good one for the long term, and still looking at it for the long term. Baidu, I said to keep an eye out. I'm hoping, I believe actually, I hope and I believe, if I remember right, Baidu was something that was reiterated by Kevin. 15th. So even if you went on Baidu this day, you'd be up significantly just looking off of that. Very cool. But anyways, I'm pretty sure Kevin had mentioned and reiterated buying leap calls on Boeing, or excuse me, Baidu, to continue to take part in this bull run through the end of last year and beginning of this year. So I hope some of you were able to catch wind from that. And yeah. So what do I want to talk about today? I want to talk a little bit about CME, and I gotta say, it's when I first heard all of the news of GameStop, I kind of ignored it, thinking it was, oh, this isn't CME, is it GME? Excuse me, GME. What a dork. All right, GME. When I first got this news, saw this news headline of GME just rocketing up out of nowhere. First thing you think of is, well, what a bunch of idiots, first of all. And why on earth would anybody invest in GameStop in a similar fashion to why would anyone invest in Blockbuster at this point? But I thought it was interesting, and I couldn't really believe how much of a stink it made. A lot of people thought that it kind of contributed to the pullback on the market towards the end last week. I guess last week of what was last week was the last week of January. And I'm not sure I bought that, but it just doesn't make any sense. But I thought it was interesting that a bunch of hedge funds lost a bunch of money, and pretty hilarious. And you know, pretty cool that a bunch of people just kind of got together and decided to do the one thing and buy a bunch of it and short squeeze the heck out of those guys and drive the price up, as they have to buy more shares of stock to cover their short positions. Just brilliant. But not a but, a but. I mean, the party can only last so long. Everybody with all their stimmy checks, these college students with stimulus checks, riding the rocket to the moon. Just can only last so long. For you run out of people to buy, and let's just zoom in. You run out of people to buy, and those hedge funds have a hell of a lot of money to continue to short, to draw from other positions, and drive the stock back down. Something that a funny question that kind of makes sense, but a lot of people that don't have any experience with the stock market, or that just I talk to, I manage money in the stock market, and one of the first questions I get is, well, why can't everybody just keep buying the stocks and just, see the stock market keep going up and up? And it obviously makes a lot of sense at first glance. Yeah, well, if you keep buying the stocks and you just keep putting your money in and whatnot, nobody has to take their money out. Nobody has to sell off. If everybody just sticks together and says, hey, all right, we're just going to keep buying, there's no selling, we're just going to buy, then stocks will just keep going up. But is that human nature to do that? What do you guys think? What would you say? Dave says, someone's always got to ruin the fun. I agree, Dave. Stupid jerks. They just ruin the fun. We're all going to the moon in our rocket ship. You just hold the line and keep buying. Just hold your stocks. Nobody needs to sell. They'll just keep going up, right? So I'm going to say it doesn't always just go up. Why? Human nature. A lot of people want to just ride the wave and get out. People get more fearful when stocks run up so quick that they're going to fall. And maybe it's even a self-fulfilling prophecy that profits are taken and people take what they can get and run. Especially with something so speculative, right? Yes, Ida, comment was the power of social media was largely Reddit. You're right. Forgot to mention that. So Reddit, we'll get to that in a minute. Robinhood played a role in, at least if nothing else, pissing everybody off and getting this whole thing to be such a stink. So human nature takes a role, and not everybody is willing to just keep their money in the market. Second thing, what happens when people stop buying? So let's say you bought the stock, and all these Reddit users following the Wall Street bets are saying, all right, just hold it, hold your money, hold your stock, don't sell, selling's for losers, nobody sell. But what's the problem? You have to keep buying. You can't just hold, you have to keep buying. Because if you don't keep buying, then shares can get sold. If you don't keep buying, it doesn't drive trading traffic to continue to drive the price up. So I'll say stock will lose momentum. Thank goodness for autocorrect. And wish I could just write what I just said. Stock will lose momentum, and the pressure to drive the price up loses, well, I just said loses momentum. The pressure to drive the price up peters out. So third thing, and I already mentioned this, but why do you guys think it fell so dramatically today and yesterday? Obviously, the first two things I mentioned play a part. So to answer that question, let's look at this S&P chart. Fell from 38.63-ish down to the 50-day at 37.15. Lost 100 points in value-ish. When you're a hedge fund and you have positions all over the place, you have seemingly all the money in the world, and you're not willing to lose on one stupid little stock that a bunch of dorks just up and decided to run the price up just to be funny and just to be a pain. Well, my thought is maybe some positions were sold to cover GME. And maybe that is what contributed in some form to why the market had fallen. Other positions liquidated to knock that GME stock back down. And as much money and as impressive as it is that all that money in retail investing, all these guys push that stock up in a coordinated effort, they just simply don't have the buying power of hedge funds and institutional money. So it's a losing game. And at some point, boy, I'll tell you, I hope a lot of these people made a crap load of money. And I hope not too many people got hurt and lost money. But, and of course, I think it's absolutely hilarious that they found out these, the amount of short float on some of these stocks, GME, Nokia, AMC, and completely took advantage of these hedge funds having to cover their shorts and drive the price up. As brilliant as all that is, it has to keep going up. Excuse me, it has to have continued buying. Retail and money is going to run out of money at some point compared to the hedge funds that can liquidate other positions if they have to, or get their cash and beat the stocks back down. And not everybody, even if you had an impressive amount of people continuing to buy, retail traders continuing to buy to get the price to go up, it's just not going to be a majority of them. Or maybe it is a majority, but not every one of them is going to stick with it. Some people are going to take some profits, and that's just human nature. And so at this point, what now? So again, hopefully some people got out with a great profit and didn't get too hurt with this whole thing. But at this point, I think that it's kind of a case of musical chairs. Get out of the stock with a profit, not a profit. Before you get stuck with a losing position. Because you got to remember, not everybody got in when it was trading down here at 14 or 12 or 6 back in September. Wow. 16. I mean, even this run is rather impressive. But this is just absolutely ridiculous. September of last year, it was trading at $5 and change, and now it's closer and hit $500. It's closer to $500 than it was to 5. I mean, absolutely ridiculous, hilarious, and kind of funny. So, kind of a good lesson. Stocks can't always just go up. You run out of money, people take profits. Other institutional money, if you're in this case betting against them, will find a way, either by putting pressure on Robinhood, maybe that's what's happened behind the scenes, or just liquidating other positions or using cash to continue to double down and drive the price back down. I do think Robinhood was kind of stupid to try and protect people from themselves. I generally don't agree with that line of thinking, whether it's the government doing it or the social media networks, or in this case, Robinhood. I'm sure they had some pressure from both sides. They don't want to, I guess, screw over their client base, which is a lot of retail investors, obviously newer investors. So they, maybe a part of it was they just didn't want people to get hurt, lose money. But, you know, sometimes these sorts of things need to work out on their own, and tough lessons have to be learned. And I think it's ridiculous that they had to get in the way, or thought they had to get in the way. Let the market take care of it, I guess, is my point. So why else would we see this? If some part of this fall from all-time highs on the S&P back down to the 50-day was institutional money selling things off, and possibly part of that going into shorting more GME, and you know, whatever the case is, I think a lot of it has simply to do with profit taking. What typically happens, this is a question for you guys, at either the end of a month, typically the end of a quarter, what do you guys think? I guess what I'm asking is what also contributed, or I would think what was the majority of what contributed to this pullback of last week, in your opinion? As you're thinking, I mean, I don't think that it had a majority to do with GME, that in that whole storyline. I mean, it could have. It's hard. Not really a way to show that. I would think that a stock going up and into the stratosphere for no reason would be a positive thing for the market. It's going up. It helps us. It all goes up. But what other reason can you find? All right, William. End of a month, profit taking, rebalancing. Absolutely. Took the words out of my mouth. So why the pullback? Last week. So I'm going to say maybe had a bit to do with the meme stocks. Nervous. Is that right? Yes. So I'm going to agree with you, William, that the majority just had to do with profit taking at the end of a month. And I'm also going to draw your eyes down here to the bottom. Been overbought for 3 months almost. Huge Christmas rally into the end of the year. At some point, in order for the market to go higher, it has to take a little breather and come back down, consolidate. Winners, profits on winners will be taken. Some losers will be gotten rid of. Man, I'm really struggling to say this in the proper way. Profits on winners, losses on losers, rebalancing so that the market can continue to head back up. So I'll say on a stock market, well, that has gotten overbought. Needs to pull back in order to head higher. And that's really kind of what it boils down to. But I think a lot of earnings, not all of them, but a lot of them coming in really profitably. Apple doing amazing record quarter, decent guidance. Some things, I think Facebook had somewhat disappointing guidance from what some investors thought, but it continued to head up after this pullback. They had a record, I believe, a record earnings quarter. So yeah, I don't see another reason, unless you guys can think of some more, as to why there was such a pullback. So with that said, I think part of the reason that we're bouncing so quickly back to where we were is not only buying back in from yesterday, the beginning of a month, but we also have this extra stimulus. We already just had this big stimulus checks and stimulus funding plugged into the market, earlier in January. And now that Biden's in, he wants to have something he can take credit for as well. And it's a bigger check, it's a bigger, prettier dollar amount. And, that is maybe a bit of a positive surprise. And it's looking like it's going to go through rather quickly with little opposition. So, all right, I've talked enough on all of that. Man, me and Kevin were just cutting up how funny it was that these meme stocks and these Reddit groups were totally killing some hedge funds. I think it's fantastic. So moving on, I've got a few ideas for trades, not GME, for heaven's sake. You missed the run up. Maybe it'll go up tomorrow. You never know. But I am going to stay far away from GME. You're welcome to do whatever you want with your money. Talk a little bit about Apple, how to bounce. Just for those of you who are clients, just to give you an idea of what we did, we had earnings around here. What day was it? I think it was the 27th. And we had rolled up our protection. We had protected it closer to somewhere around 130, 135. I'm drawing a blank off the top of my head, but we rolled it up to at the money that if it fell, we could do a little better on the way down, which is what we did. And to see it sell off and make some money on those puts was nice. When we saw it bounce Monday, rather than just take the whole thing off, we decided to be more prudent, take half of the puts off in case it decided to, bounce down from this pivot point and test this 50-day. But today gave us another bit of reassurance that it's having a decent bounce, and took the rest of our protection off from Apple. So I like that. Those of you who were wondering what we were doing, as far as some trades, I wanted to look at Costco, possibly Facebook, and JP Morgan. So Costco, I was very close to buying more call contracts of Costco to do a little bit of dollar cost averaging. And seeing this bounce here to add a little bit more. The idea would be just to, if I had 4 contracts, I would add 2. And if I already had 2 contracts, I would add 1. Just adding about half the amount of contracts because it hasn't fallen enough where we're truly meaningfully dollar cost averaging. But with the frame of mind of how I've traded this one in the past, is to have several leap calls, and at the lower end of a range you add some, or you get your first position in at that point, and wait till it gets to the higher end of the range, looking at around 375-ish. If not, it would be great to see it to go up to 385. But the idea is buying in around here and selling some of them when it gets up to this point, taking a profit and then holding the rest in case it continues to go up through a longer period of time. That's the idea. So I was close to doing it today, but if I'm completely honest, I didn't want to do that and then come and tell you guys and front run a trade like a dishonest piece of crap. So instead, I'm telling you about it now to look at it for it tomorrow. So whether it's a first position or if you already have some Costco leap calls, not a bad one to play a range where we could see it get back up to the higher end of its range and you could take profit on some of those calls, if not all of them, if you really wanted to. So why am I looking at, and maybe this, I'll throw this out of the question for you guys, why would I be looking to do that at this point? And in some form, I kind of answered the question, but I'm kind of trying to dig a little bit more from you guys. Why would I think right now is a good point to buy to dollar cost average? And what's so important about this support level? William says 350 round number, and I certainly think that could be part of it. So good call, William. What else do you guys think? And hold on, let me get back to this. Oh, and I'm logged out. So let me log back in while you guys are thinking. Get this taken care of and get on our way. All right. Just getting myself logged back in. Sorry for the awkward silence. So this is what I'm looking at. Go down to Costco. Now I already have these 380 calls. Ignore these ones down here. That's another client doing what he wants to do. But these are ours, 380 calls. We paid about 28 for them, 27.71, just under 28. They've gone down a bit to where we can buy them a little cheaper, but really not a significant dollar cost average. It really has more to do with this support level. So no more comments coming over. Here's what I'm looking at. I thought, I wonder if Costco is going to repurchase any shares. So I did a Google search. This was the first one that came up. Obviously published April 2019. But if you go down to this sentence, it says the company said its board reauthorized a $4 billion buyback program that will expire in April 2023. So if you can put two and two together, I'm thinking that this price level, round number at 350, thank you, William, but also technical bounce off of 50 down here. This was a resistance level, which if you guys know, of course, that past resistance is future support. So 350, even though it's in the between a 50 and a 200, just kind of seems like it's sitting in the middle of nowhere. I just think that this seems like a decent place that you would see Costco repurchase some shares to keep their price point up a bit. Don't know that for sure, but it seems like a pretty good indication. So Costco leap calls. So keep an eye on it tomorrow. If it goes below 350, wait a day. Wait for a better signal of support level. Maybe it's down at 342 where they have a pivot point, or maybe it'll go down to the 200 day. Obviously, use your brain, and if it starts heading down that way, don't put on a new position. Or if you already have some Costco leaps, then wait, because then you'll get a better chance to dollar cost average and have a more meaningful dollar cost average. So that's that, and they are the January 22 380 calls. And the price point to try and get them would be around 24 or 5. Again, really the only reason I would be looking at dollar cost averaging now, even after I just bought it when it was trading at around 361 after they had this bounce, is just simply this is a nicer looking support level. And if it gets up to 360, you can take those zones off and just have the original ones left on to run. You can wait to see if it gets a little closer to the 50-day. I mean, there's a lot of options, and any opportunity to take a profit there, it reduces your cost in the trade of Costco with anything you have left over. So that's something I like, and I would keep an eye on that if I were you. Just quickly going over Facebook, I'll be honest, I wish I would have caught this one down here at the 200-day. Made perfect sense, but this was the beginning of the year, and this was the fallout from the whole all of the idiots that stormed the Capitol and Facebook trying to deplatform people and get rid of all of the QAnon nonsense along with Twitter. But conservatives didn't like that, and the irony is all of the pressure from the left side of the aisle is really what drove, I think, what am I trying to say? What drove the pressure on the social media companies to do that, even though it was kind of cowardly and silly, driving the price back up because now we have a new administration that they got to kowtow to, and they did their bidding. They don't want to be Facebook. I'm saying Facebook, all these social media companies, Twitter, they don't want to get hit with antitrust suits, which have been threatened on the left side and the right side for different reasons, obviously. What's that rock in the hard place they're having to deal with? But 2 times now it's bounced off of this 200-day, and I would like to look at riding that up through close to 285 or even 300 if it ever gets back up to there. But I'm going to be looking at, well, I don't have any Facebook to look at right now, but let me look. Trading. Facebook options. Oh, thanks for that. January 22, maybe even June 22. Let's go down here. I might be looking at somewhere around 285, because that's kind of our price point we're looking to see it get up to. If not, even that's January 23. No wonder they're so expensive. So you could go out that far. The problem I have though with Facebook, just thinking out loud, is they just also picked a fight with Apple that will most likely be a losing battle for them. And that is really the only thing that currently that I would be worried about. But you have the option of a June 285. Let's look at the January 22s. Oops, too far. January 22s don't come in $5 increments, so you're looking at 280, or you could even go up to 300 to give yourself a little more space. So I'm just going to say keep an eye on Facebook January 280 or strike with an I. Forgot to put January 22. More time is always better if you've got the money to go out to June or January 23 and you really believe in the future of Facebook, which I do. I just think that the near term, they've traveled sideways for so long now that you could be having to deal with more of that. And the issues that have caused them to trade sideways haven't really been resolved. So we're just looking to play it similar to Costco in the near term of a support and resistance. 246 was the low, 285 is the high, and that's the channel that we're looking at. So that's what I would be looking to do. Okay. How do I get this to go over like it has it on Costco? I struggle with Word, I'll be honest. JP Morgan, and this is the last one. I'll let you guys go. I've kind of been long-winded. Forgive me. It's been a while. Had a lot to say. JP Morgan. So typically we have the banks kind of don't typically do extremely well during the first quarter of the year. Not saying that it couldn't or wouldn't happen this year after they'd gotten beat up so much the year before and kind of getting back to where things were prior to the pandemic. But my thought here is the likelihood that they may not fall much, with the likelihood that they might not really take off, and they meaning just banks in general. I wanted to look at a covered call. So if we go to JP Morgan, if you'd like some money to be put to work and looking at a covered call, we could look at February monthlies. And we're looking for it to expire around probably 140. You could go up to 150. That would make sense, but let's see, if you want to hold on to it and it's a new position, yeah, that one's not going to work. 150. Be looking at 140. Closer to the money, you get $1 out to February. I kind of want more. Let me look at February 26th. So not much for 150. Again, looking closer to 140. So there's a couple ways you could look at this. If this is a stock you haven't gotten a chance to get in and you would like JP Morgan that has a dividend yield of 2.78. See, next dividend date. We missed the dividend date, so that's not going to work. However, that doesn't mean we can't just play the range, like kind of what we're doing with other things, but with a good, reliable company, stock that we could get a decent credit for. Could even go closer to 139. That gives you tons of upside. I mean, really, anything through here isn't bad. If you're just looking to take a covered call profit and get called away, I would go closer, maybe 135. You get tons of credit, $4 of credit. If you're looking to have more gain and see if it tests or goes past the upper level of where it's trading through, you'd go up to 140, which is still a decent credit. As I'm talking through it, I'm really liking the idea of closer to the money, where you have a bit more credit there for protection and pretty close to the money, and get called away for a decent profit. I mean, 135, $4. So what is that? %3 in 24 days. I like that. I'm going to suggest the 135. Let's see, I'll put the date, February 26. Covered. I would think you got a good chance of being called away. If it's something you wanted to be in for a long time, go up further, but just be okay with not getting as much credit, and on the hope that you'll have a lot more gain in stock from 133 up to 139 or 140 if you put it up that high. But this is more of a trade, so I'm going to go with this 135 strike covered call, JP Morgan. where you buy the stock and sell a short call to deliver that stock at a higher price and get paid for it. So for about, I guess it's between $3 and $4. So try to get more like $4, which you probably would if it's heading up, heads up tomorrow at all. But obviously you'd subtract that from where your purchase price would be of the stock. So I'm going to say $3.50, $4 of credit. So a lot of stuff to look at, some decent things to look at, and more stimulus coming into this market to probably drive it up more. Let's be honest. And guys, I think that does it for me. Is there any other questions or thoughts that you have? Go GME. Right on. Thanks, William. Apparently William's making some good money. He's going to show us up with all of his GME. All right, guys. It was fun to be with you tonight. Thanks for joining me. Wow, what an interesting stock market. All right, that does it for me. No more questions coming over. Appreciate you guys. Have a good evening, and I will see you back here again Thursday morning. So look forward to following up with you and seeing where things go. Have a good night.